What do you think about his thought that we're going to enter a technical recession later on this year? And what's the difference between a real recession and a technical one?
Well, first of all, I think economists and investors have rarely been this divided in their outlook for the economy. Investors really fall into two camps. There's the soft landing camp, where we see a decline in inflation, but we don't see a decline in the economy, and the hard landing camp, where we see a decline in inflation as well as a decline in the economy. Our feeling is that there are some headwinds. There are definitely some signs to watch out there. For example, the yield curve is extremely inverted right now. The leading economic index has continued to go down. But watching all this, the U.S. consumer is on pretty good footing. And that represents, it's important because the U.S. consumer represents about 2/3 of the overall economy. So I think starting off this year, there's been some positive momentum. We had a blockbuster January jobs report of 517,000.
Right.
The retail sales numbers last month were pretty strong.
Agreed.
And this ISM services index, which has come out, has been above 55 for 2 straight months. So right now, things look okay, but there are some headwinds. So we could see some weakness in the economy as we go through the year.
So, Michael, I have to ask you, you danced around it just a little bit. Do you agree with Brian Moynihan? And as you look at investments going forward, is your investment strategy with the thought that we're going to enter some type of recession, technical or otherwise?
I think the odds are in the favor that we'll have some further weakness this year and a possible recession. Remember, in the first 2 quarters of last year, we had 2 negative quarters of GDP. And typically, that's sort of the household definition that you have of recession. But we didn't have weakness in many other parts of the economy. This time around, we're seeing some weakness in economically sensitive parts of the economy, like housing and manufacturing. The key will be if we start to see weakness in the U.S. consumer. And for that, I think it's most important to watch the weekly jobs numbers, which are a timely indicator that come out each Thursday morning.
All right, you're talking about the weekly jobs numbers. Let's look ahead to the monthly job number. You mentioned last month, blowout jobs report. I think it shocked just about everybody. But this week, what's going to have a bigger impact on the market in your mind? Powell's testimony or that Friday jobs number?
I think they're both important in different ways. Today, Powell needs to sort of talk tough and indicate that the job is not done yet. The markets right now are pricing in a 5.5% short-term Fed funds rate, and that's a lot higher than the 5% rate we started the year with right now. Powell has to indicate that the job is not done yet, and I think that could put some pressure onto the markets. But ultimately, Powell will say that the markets and the Fed are data dependent. So I think that'll be okay for the markets to handle. When we get to Friday's jobs report, over the past 12 months, jobs have gained about 369,000 jobs per month. It's only normal to expect some slowing as the job market reaches full employment. So if we get a number, say, above 250,000, that could put some upward pressure on interest rates this Friday. Maybe a number under 200,000 would be probably sort of 150 to 200,000 would be the number the market's looking for.